Hello, friend. Welcome. Today you are not just listening to a book. You are learning a life skill. A skill that schools rarely teach. A skill that decides whether a person stays stressed about money or becomes financially peaceful. This book will not teach you how to get rich quickly. It will teach you how people slowly become wealthy and why most people fail. So relax. Listen slowly. You do not need any finance knowledge. You only need attention. Let us begin. The story of a genius who lost everything. Many people believe only uneducated people lose money in the stock market. They think smart people win. Careless people lose. But history shows something very surprising. One of the smartest humans in history lost a huge amount of money investing. His name was Isaac Newton. Yes. The same scientist who discovered gravity. In the year 1720, there was a company in England called the South Sea Company. People believed this company would become extremely successful. Everyone was talking about it. In homes. In markets. In offices. The stock price was rising every day. Newton invested his money. After some time, he earned profit. He felt satisfied. He sold his shares. He believed he made a smart decision. These feelings make intelligent people take foolish decisions. The pattern that repeats. This event was not unique. The same thing happens again and again in history. First, a new opportunity appears. Early investors earn money. News spreads everywhere. More people join. Prices rise higher and higher. Soon the price becomes unrealistic. Then the crash happens. And the last people entering lose the most. This happened during the tulip bubble. It happened during the 1929 stock market crash. It happened during the dot-com internet bubble. And it still happens today. Only the story changes. Human behavior stays the same. Is the stock market gambling? Many people say the stock market is gambling. But the truth is different. The market itself is not gambling. People behave like gamblers. They chase popular stocks. They follow news headlines. They panic and sell when prices fall. They try to predict crashes. This is exactly what Newton did. And this is exactly what beginners still do. The real danger is not investing. The real danger is trying to be smarter than the market. The real secret. Here is the most important idea. Trying to predict the market destroys investors. Long-term investing builds investors. In the short term, the market moves up and down. But over long periods, it grows. Slowly. Quietly. Powerfully. Wealth is not created by intelligence. Wealth is created by patience. The people who succeed are not the smartest. They are the calmest. They allow time to work for them. This is the first step of becoming a good investor. Before learning how to make money, you must first learn how people lose it. Chapter 2: The Myth of the Perfect Stock. After learning why people lose money, we now learn another mistake. Almost every beginner investor believes one thing. They think there is one special stock. If I can find it early, I will become rich. This idea feels exciting. It feels logical. But it is also dangerous. The author calls this belief the search for the rare pearl. People imagine buying a company today. And one day it becomes the next Apple or Tesla. Their small money becomes huge money. This dream attracts millions of people to the market. But reality is very different. The story of a confident investor. The author once met a very successful investor. The investor carefully studied companies. He read financial reports. He analyzed business plans. He invested a large amount of money into one company. Everything looked perfect. Strong demand. Growing industry. Clear future. Anyone listening to him would feel confident. But a few years later, the company failed. It went bankrupt. Its stock lost almost all its value. Even experienced investors cannot always choose the winning company. Knowing the future is not enough. Let us think about the past. When cars were invented, everyone knew something. Cars would change the world. So investing in car companies should have made everyone rich. But more than 2,900 car companies existed. Almost all disappeared. Only a few survived. So people correctly predicted the future. But still lost money. Why? Because predicting an industry is easy. Predicting the winning company is extremely difficult. Exciting industries attract trouble. History repeats this again and again. Whenever a new exciting industry appears, investors rush toward it. Technology companies, internet companies, electric vehicles, new energy. People feel they found a shortcut to wealth. Prices rise quickly. Many investors make money in the beginning. They feel intelligent. But after some time, prices fall. Some companies fail. And late investors suffer heavy losses. Excitement creates attention. But attention does not create wealth. Even professionals struggle. Now you may think professionals are different. They have education. They have research teams. They have experience. Surely they can choose the best stocks. Surprisingly, studies show something else. Over long periods, most professional fund managers perform worse than the overall market. Not a few. Most of them. This means even experts struggle to consistently pick winners. A shocking discovery. Researchers studied thousands of companies across many years. They found a surprising result. Only a very small number of companies created most of the market's growth. Just a tiny percentage. If you missed those few companies, you missed most of the returns. And nobody knows in advance which companies they will be. Not analysts. Not financial news. Not anyone. A better idea. Imagine a long bicycle race. You have two choices. You can try to guess the top 3 winners. Or you can own the entire group of riders. If you own the entire group, you automatically include every future champion. This is the idea behind a smarter investment strategy. Instead of choosing one company, you invest in many companies together. You do not depend on prediction. You depend on time and growth. The biggest mistake investors make is searching for the perfect stock. The successful investor does something different. He does not chase the rare pearl. He owns the whole ocean. Chapter 3: Your share of company profits. Now we understand something important. A good investor does not search for one magical stock. But a new question appears. If we do not trade every day, then how do we actually earn money from stocks? To understand this, imagine a small business. Suppose you and your friend open a bakery. Customers come every day. They buy bread. They buy cakes. They buy snacks. At the end of the year, after paying all expenses, money remains. This money is profit. Now imagine you are a co-owner of the bakery. You helped invest money at the beginning, so you deserve part of the profit. Your friend gives you your share in cash. You did not work in the bakery daily. You did not sell bread. But you still earned money. Why? Because you are an owner. What a stock really means. A stock works in the same way. Many beginners think a stock is just a price moving on a phone screen. Up today. Down tomorrow. But a stock is not a number. A stock is ownership. When you buy a company's stock, you become a small owner of that company. Maybe a tiny owner, but still a real owner. If the company earns profit, You deserve a part of that profit. Dividends. Companies reward owners in a simple way. They give something called a dividend. A dividend is real money. The company sends cash to shareholders. You do not need to sell your shares. You do not need to predict the market. You simply receive money because you own a piece of the business. Some companies do this every year. Some even do it every few months. This changes how we see investing. You are not buying numbers. You are buying income. The power of reinvestment. Now something powerful happens. You receive dividend money. Instead of spending it, you buy more shares. Now you own a bigger part of the company. Next year the company earns profit again. Now your dividend becomes larger. You again buy more shares. The cycle repeats. Each year your ownership grows. Your income grows. And the growth becomes faster. This process is called compounding. At first it feels slow, almost invisible. But over many years, it becomes extremely powerful. Small money slowly becomes large wealth. Why many investors fail? Many people focus only on price changes. They watch the market daily. When prices rise, they feel happy. When prices fall, they feel fear. They buy high. They sell low. They react emotionally. A real investor behaves differently. He does not ask, "What will the price be tomorrow?" He asks, "Is this business earning profit and continuing to grow?" If the answer is yes, time becomes his helper. He does not worry about daily news. He does not panic during short-term drops. He simply remains an owner. And businesses continue working for him. Stocks are not lottery tickets. They are not guesses. They are pieces of real businesses. Businesses create profit. Profit creates dividends. Dividends create compounding. Compounding creates wealth. This is how ordinary people slowly become financially secure. Chapter 4: Stocks and Bonds. Now we understand that stocks mean ownership in a business. But investing does not have only one type of asset. There is another important type called a bond. To understand this, imagine two different situations. First situation. You open a small restaurant with your friend. You invest money. You become a co-owner. If the restaurant earns profit, you earn profit. If the restaurant struggles, you also suffer. This is a stock. You are an owner. Second situation. Your friend opens a restaurant. But this time, you do not want ownership. Instead, you lend him money. He promises something simple. Every year he will pay you interest. And after some years, he will return your original money. You are not an owner. You are a lender. This is a bond. The difference. A stock gives growth. A bond gives stability. Stocks are powerful over long time. But they move up and down. Sometimes strongly. Sometimes suddenly. Bonds are calmer. They usually grow slowly. But they fall less during difficult times. Stocks are like a fast car. Bonds are like a seatbelt. The car helps you reach your destination quickly. The seatbelt protects you during accidents. You need both. Why investors need both? Many beginners want only stocks. They want maximum return. But they forget something important. Human emotions. When the market falls sharply, fear appears. People panic. They sell their investments at the worst possible time. They do not fail because of bad investments. They fail because of bad reactions. Bonds help solve this problem. When stocks fall, bonds usually fall less. Sometimes bonds even rise. So your total savings do not drop as much. This gives peace of mind. And peace of mind allows patience. Age and risk. Young investors usually have time. They can handle ups and downs. Older investors need safety. They may need money soon. So they need more bonds. There is no single perfect mix. But the idea is simple. More stocks, more growth, more volatility. More bonds, less growth, more stability. A good investor chooses a balance he can emotionally handle. Because the best plan is the one you can follow for many years. The real goal. The purpose of investing is not excitement. It is not daily profit. It is stability and long-term growth. Stocks help your money grow. Bonds help you stay calm. And staying calm is one of the most valuable skills in investing. A strong portfolio is not built only on return. It is built on behavior. Because a good plan only works if you continue following it. Chapter 5 are driving at 130 miles per hour. Imagine you are driving a car. The road is long and straight. Your speed is very high. About 130 miles per hour. Now imagine something else. You are looking outside the window every second. You watch every small movement of the car. You notice every tiny shake. Every small sound. Very quickly. You become nervous. You start believing something is wrong. You slow down suddenly. You brake again and again. Your fear comes not from danger, but from watching too closely. This is exactly what many investors do. Watching the market too much. Today people can check stock prices anytime. On the phone. On apps. On websites. Every minute. Every hour. Prices move constantly. Up a little. Down a little. If you watch these small movements daily, you feel stress. When prices rise, you feel excitement. When prices fall, you feel fear. Soon you start reacting. You buy when prices already went up. You sell when prices already went down. Your decisions come from emotion, not logic. Short-term noise. In the short term, the market behaves unpredictably. News changes prices. Rumors change prices. Politics changes prices. Even random events change prices. These movements do not represent real business growth. They are only noise. But your brain treats them as danger. So you react. And every reaction slowly damages your returns. The real investing horizon. Businesses grow slowly. Factories produce goods. Workers create services. Customers return again and again. Profits grow over years. Not days. Not weeks. Not months. Years. A real investor thinks in years. But frequent checking forces you to think in hours. And when you think in hours, you behave like a trader, not an owner. Why professionals avoid constant checking? Successful investors often do something surprising. They do not constantly watch the market. Some check only a few times per year. Why? Because they understand something important. Information is not always helpful. Too much information creates anxiety. Anxiety creates bad decisions. Bad decisions reduce wealth. Less watching often leads to better investing. The hidden damage. Imagine two investors. The first checks prices daily. The second checks once a year. Both invest in the same companies. Over many years. The second investor usually earns more. Not because he is smarter. Because he is calmer. He gives time for businesses to grow. He avoids emotional mistakes. The market always moves. But wealth does not come from movement. Wealth comes from patience. The less you react to daily noise, the closer you move toward long-term success.